Welcome to the Deep Dive. Today we're tackling derivatives. Now, that might sound a bit intimidating, I know.
It often does at first.
But it's really fundamental if you're going into finance. We're going to explore this using Professor Oz's Introduction to Finance notes, really aiming this at you business undergrads just starting to get your head around these concepts.
Exactly. And at its core, a derivative isn't that complicated. Think of it like this. It's a financial contract, right? And its value derives from something else, an underlying asset.
Okay, derives from. Makes sense.
Yeah, and that something else could be, well, almost anything. Stocks, bonds, oil, interest rates, even the weather, believe it or not. It's basically a way to manage risk about future prices, or maybe try to profit if you think you know where prices are heading.
And Professor Oz's notes really lay out just how broad that something else can be.
Yeah.
We've got the usual suspects. Stocks, bonds, indices.
Yep, the familiar stuff.
But then, like you said, crude oil, gold, interest rates, foreign exchange rates, and things I wouldn't have immediately thought of, like weather patterns, energy prices, freight rates.
Exactly. And the notes even have this playful example, like a contract based on whether a student makes the honor roll.
Okay.
Which sounds silly, but it really drives home the point. It's about a payout depending on some specific condition or outcome. It shows you how flexible the core idea is.
It's interesting how that basic idea can lead to such specific tools.
Precisely. It allowed for very tailored financial instruments.
So our mission for this deep dive is pretty clear then. We want to give you a straightforward, practical grasp of what derivatives are, the main types you'll run into, who's using them, why they matter so much in finance.
Without getting too bogged down in the super complex math right away.
Yeah.
Keep it accessible.
Okay, let's dive in. What are the sort of main categories of derivatives we should know about?
Well, Professor Oz's notes highlight 4 key ones. First up, options.
Options. Okay.
These are contracts that give the buyer the right, and this is really important, the right, but not the obligation.
Not the obligation. Got it.
To either buy an asset that's a call option or sell an asset that's a put option. And this is at a specific price, the strike price, by a certain date, the expiration date.
So it's like holding a reservation for a price. You can decide later if you want to use it. Can you give us a quick example?
Sure. Let's take Tesla stock. Say there's a Tesla call option expiring January 2026 with a strike price of $250. And maybe it costs $72 right now to buy that option.
Okay, $72 is the price of the option itself, the premium.
Exactly, that's the premium. So you pay $72 per share for the right to buy Tesla at $250 anytime until Jan 2026. Now, if Tesla's stock price, say, shoots up to $350 before then...
Which with Tesla, you never know.
Right. You then have the option to exercise your contract. You buy the stock at $250, even though it's trading at $350. You could immediately sell it for $350. You make $100 minus the $72 premium you paid. A profit.
But if the price stays below $250...
then you just let the option expire. You wouldn't buy at $250 if you could get it cheaper on the market, right? So your maximum loss is just the $72 premium you paid up front. It's a right, not a requirement.
Where the choice is yours. That
Yeah.
makes sense. And a put option is the flip side, the right to sell.
Precisely. Let's stick with Tesla. Jan 2026, $250 strike price, but this time it's a put option. Maybe the premium is $64. This gives you the right to sell Tesla stock at $250 until that date.
So you'd want this if you think the price is going down.
Exactly. If Tesla's price dropped to, say, $150, you could potentially buy the stock on the market for $150 and then use your put option to force someone to buy from you at $250. Again, you'd make a profit after subtracting that $64 premium.
Okay.
And Professor Oz even has a little quiz question reinforcing this, asking what a put option gives you the right to do, and the answer is clearly sell. He also includes questions to catch common mistakes, like thinking you'd exercise a call option if the stock is below the strike price, which you wouldn't.
Good way to test understanding. Okay, options covered. What's next?
Next are forwards, forward contracts.
Forwards.
These are more like customized agreements made directly between two parties. They agree to buy or sell a specific asset at a set price on a specific date in the future.
So tailored deals. Not like something you just buy on an exchange.
Exactly. Customized is the key word. The terms fit the exact needs of the buyer and seller. And usually, there's no upfront cost to get into the contract, unlike options. But here's the other big difference. It's an obligation.
Okay. So with options, you can buy or sell. With forwards, you must buy or sell.
You got it. Both parties are locked in. They have to follow through on the agreed date.
How would a business, maybe a smaller one just starting out, use something like that?
Well, a classic example is an airline like United. They need jet fuel, obviously, huge expense, and the price fluctuates a lot.
Right.
So United might enter into a forward contract with a fuel supplier today to buy a specific amount of jet fuel for delivery in, say, 6 months at a price they agree on now.
So they lock in their fuel costs, protect themselves if prices go up.
Precisely. It's called hedging. It makes their budgeting way more predictable. Plus, they don't have to worry about storing tons of fuel themselves. The supplier handles that until delivery.
And the supplier on the other side, they might want to lock in a selling price too.
Could be. Or it might be a financial institution just taking the other side of the bet, speculating on the price.
Okay, so forwards. Custom, obligation, direct between parties. Now, futures sound kind of similar, but different.
They do sound similar, and they also involve an obligation to buy or sell later at a set price. But the key differences are standardization and exchange trading.
Standardization.
Yeah. Futures contracts are highly standardized. They specify the exact quantity, quality, delivery dates, everything. It's all preset. And because they're standardized,
They can be traded easily.
exactly. They trade on organized exchanges like the CME, the Chicago Mercantile Exchange. This makes them very liquid, easy to buy and sell quickly. And the exchange itself acts as a middleman, a clearinghouse.
What does that do?
It drastically reduces the risk that the person on the other side of your contract won't pay up or deliver. We call that counterparty risk. With forwards, since it's just two parties, that risk is higher. With futures, the exchange guarantees the transaction.
Oh, okay. So less risk, easier to trade because they're standardized and on an exchange.
That's the gist. And again, Professor Oz has a quiz question. Which type of contract trades on exchanges? The answer, futures.
Got it. Options, forwards, futures. And the last one was swaps. You mentioned that briefly.
Yeah, swaps, the notes just touch on them. Basically, they're agreements to exchange cash flows over time. They can get pretty complex, so for an intro, just knowing they exist as another derivative type used for managing risk or speculating is probably enough.
Okay. Good overview of the type. So thinking about, future careers for the business undergrads listening, who's actually using these things day to day and why?
Broadly speaking, two main groups, hedgers and speculators.
Hedgers first. That sounds like the United Airlines example.
Exactly. Hedgers use derivatives to reduce risk they already have. They want to protect themselves against prices moving the wrong way. Locking in the jet fuel price is perfect hedging. It reduces the uncertainty of a major cost.
Makes sense. Protecting the bottom line.
Precisely. And Professor Oz shares this great fun fact about McDonald's and Chicken McNuggets.
Well, what's the story there?
Well, when McDonald's was getting ready to launch McNuggets, they needed a stable price for chicken, right? Ray Dalio, founder of Bridgewater Associates, had this idea.
Okay.
He realized the chicken producers' main costs were baby chicks and feed mostly corn and soy meal. So he suggested the producers use futures contracts on corn and soy meal to lock in their feed costs.
Hedge their own costs.
Right. And because the producers could lock in their costs, they could then offer McDonald's a stable, fixed price for the chicken needed for McNuggets.
Wow. So futures help make the McNugget possible at a predictable price.
Pretty much. It's a cool, real-world example of hedging enabling a major product launch. Shows how derivatives aren't just abstract finance stuff.
That's fascinating. Okay, so hedgers reduce risk. What about the other group, speculators?
Speculators are the opposite in a way. They use derivatives to take on risk, hoping to profit from price changes. They're betting on which way the underlying asset's price will go.
Like betting Tesla stock will go up with that call option earlier.
Exactly. And derivatives often offer leverage. This means you can control a large amount of the underlying asset with a relatively small initial investment, the option premium, for instance.
Which means bigger potential profits.
But also bigger potential losses. Much bigger. It magnifies everything. Professor Oz calls this the dual nature of derivatives, tools for reducing risk via hedging, or tools for taking on risk via speculation.
And that speculation side carries some serious warnings, right?
Yeah.
The notes mention some big blow-ups.
Absolutely. They serve as important cautionary tales. There's the Society General case from 2008. One trader unauthorized bets on European index futures, billions in losses.
Gotcha.
And more recently, 2021, the collapse of Archega's capital management. They used complex derivatives, total return swaps mainly, and when their bets went wrong, big banks like Credit Suisse and Nomura lost billions.
So powerful tools, but you need strong oversight and risk management, especially with speculation.
Definitely. Lack of understanding or control can lead to huge problems.
Okay. Now, the notes also bring up some other interesting applications, like how derivatives connect to paying executives.
Right. This is a really relevant point for business students. Companies often give executives stock options and stock grants as part of their pay package.
Why do they do that?
The idea is to align the executive's interests with the shareholders. If the execs help the company do well, the stock price should go up. That makes their own stock and options more valuable.
So it incentivizes them to focus on long-term company performance.
That's the goal. Encourage decisions that boost shareholder value. Professor Oz uses Hyatt Hotel's compensation plan as an example where a lot of the top execs' pay is tied up in stock and options.
Interesting link. The notes also cover that wild time in April 2020 when oil prices went negative. How does that even happen? Negative price.
Yeah, that was truly bizarre. Unprecedented. The price for West Texas Intermediate crude oil futures, specifically for May 2020 delivery, actually fell below zero, like negative $37 a barrel at one point.
Meaning they'd pay you to take the oil.
Essentially, yes, it was this perfect storm. First, there was way too much oil being produced. OPEC couldn't agree on cuts. Then, bam, COVID hit. Lockdowns everywhere.
Demand just collapsed. No one driving, flying.
Exactly. Massive oversupply, suddenly no demand. But the futures contracts were for physical delivery in May, and there was simply nowhere left to store all that oil.
Store tanks were full.
Completely full. So if you held a contract obligating you to take delivery of oil in May, you had a massive problem. As the expiration date got closer, traders got desperate to get rid of those contracts to avoid taking physical delivery.
So they paid people to take the contracts off their hands.
Wow. It's a dramatic, extreme example of how physical commodity markets and futures can interact, especially under stress. Really highlights the risks.
Definitely memorable. Lastly, there's this connection to pop culture and some unusual regulations.
Yeah, a bit of fun trivia mixed with real history. Professor Oz mentions the movie Trading Places.
Classic. Eddie Murphy, Dan Aykroyd, frozen concentrated orange juice futures.
Exactly. It's probably the most famous pop culture depiction of commodity trading. But then there's the real story of onion futures.
Onion futures.
So back in the 1950s, some traders apparently tried to corner the market on onions, manipulating prices like crazy. It caused chaos for onion farmers.
I bet.
The outcry led Congress to pass the Onion Futures Act in 1958, specifically banning futures trading in onions. And that ban is still in place today.
You cannot trade futures on onions. That's amazing.
And it's not the only ban. More recently, futures based on movie box office receipts were also prohibited. Concerns about manipulation, mainly from the movie studios themselves.
Huh. So there are specific things you just aren't allowed to create derivatives for. Professor Oz quizzes on that too.
Yep. Which commodities are banned from futures trading? Onions and movie box office receipts.
Wild. Okay, so wrapping this up. Based on Professor Oz's notes, what are the absolute key things our listeners, especially those undergrads, should take away from this deep dive?
I think number one is just the core concept. Derivatives get their value from something else, an underlying asset. They're tools.
Tools with different forms.
Right. Remember the main types. Options, the right, not obligation. Forwards, customized obligation, and futures. Standardized obligation traded on exchanges. Swaps too, but the first three are key initially.
And they're used for two main reasons.
Primarily, yes. Hedging to manage or reduce risk. Think United's Fuel or the McNuggets story. And speculation trying to profit from price moves, which comes with higher risk. Think the call option bet or, unfortunately, the Socken example.
And understanding this stuff really is crucial for anyone going into finance or even just trying to understand business news today, wouldn't you say?
Oh, absolutely. Whether you end up directly managing risk for a company, analyzing investments, or just reading the financial pages, knowing what derivatives are and how they work is becoming pretty essential.
Okay. So considering everything we've discussed, the power of these tools, from locking in costs for airlines and fast food, to those extreme market events like negative oil, and even banning futures on onions. Here's a final thought for you to chew on. What other, maybe unexpected parts of our economy or even our daily lives might be shaped by derivatives? And as you head into your careers, what are the big opportunities and maybe the hidden risks you need to be aware of when dealing with these powerful instruments? Something to think about. Thanks for joining us for this deep dive.